Hey guys, it's Sebastian from AskSebby, and today we are going to look at the economic situation and how it's affected credit applications early on. One big favor before we dive into all of this is to give this a thumbs up. It doesn't cost you anything at all, and it really does help with that algorithm, especially given all the stimulus information out there right now and all of those videos. It actually helps it rank. If you really like the video, if you really like this channel, consider subscribing and turning on notifications. We're almost at 150,000 subscribers. What we're looking at is going to be from the CFPB, so this is the Consumer Finance Protection Bureau, and they analyze data from March. So they got this in April, and then they released it in May, but this is going to be March data. So a bit early on with this whole situation, but I think it's a good prelude before we see the April and May data. If you want to check this out yourself, I think it's a pretty interesting read. It does look into different things such as auto loans and mortgages and credit card stuff, which is pretty interesting. They have a lot of information on their methodology, which I think is important, but for the purpose of a YouTube video, that's probably going to bore you guys. What you need to know is that they're comparing 2020 information with 2013 to 2019, which I think is a pretty fair overview, but depends on how you interpret data. First thing we're going to look at is inquiries for auto, mortgages, credit cards, and other. For week 2, 3, and 4, the biggest impacted is going to be auto, which isn't too much of a surprise. I think whether you're someone who's low income or high income, whether you're someone who has good credit or bad credit, you're not actively looking for a car if you know that you're locked down. For people who need a car for work, they're probably looking for something secondhand that they can afford with cash. So like an old Camry or something versus a new car where they're getting that new loan. The rationale being that if money is going to get tighter, you don't really want to blow that on a new car. In comparison though, mortgages were pretty much unaffected in week 2, and then they only really got hit in week 3 and 4. I'm actually pretty surprised by this, but then at the same time, I'm reading articles right now about how the super rich are still buying super expensive $50 million mansions, so there's that as well. I guess the other part of it was that interest rates were low, so people were locking in their mortgages. Final one we're going to look at is credit cards, and we did see pretty big drops, week 4 being down almost 40%. If we break these down by credit rating, so we have deep subprime, subprime, near prime, prime, and super prime, we can see a few changes within the auto industry. It's not always true, but generally speaking, you do see people who have higher incomes have higher credit scores. I definitely know a few people who make something like $300,000 a year because they work at a FAANG company, but they also have very bad credit because they are pretty much paycheck to paycheck. On the flip side, definitely there's going to be people who don't make as much, but who are just responsible and who know how the game works and how to keep their credit score good. So probably not true for the people watching this channel, but for the average American, I do think that higher income generally is higher credit score. So for auto loans, the most affected was super prime, so that dark green line. The least affected was deep subprime, subprime, and near prime. I'm not too surprised by this because there are going to be a lot of jobs where you do need that car in order to actually do the job. For mortgages, the most affected in week 4 was super prime, but they didn't really feel it in week 2. Least affected was deep subprime as well as near prime. I'm actually a bit surprised by this. A bit of me also wonders whether banks were just not looking for people because at a certain point, if they're not making enough money and if your credit score is too high, they can't really charge interest and it just doesn't really make sense financially. If you have a bad credit score, they know they can charge you interest because they have to account for that risk. But if you are super prime, then it's going to be a lot harder to justify. Moving to credit cards, we have very big declines on the super prime side. So if you look at that dark green line, you can see that it goes down to negative 60%. So imagine if the average between 2013 and 2019 was 100 people, now only 40 people were applying for those cards. My guess for this, and this could be completely wrong, is that a lot of this demographic focuses more on travel rather than cashback, and for them, it might not make sense to get those travel cards right now. You don't know how long this is going to last, first off. Second off, the offers might end up being better, which is something that I mentioned a few times in different videos. And third off, it just doesn't really make sense to plan that ahead until we really know what it looks like even for the summer. There can be cashback people within this demographic as well, but generally speaking, I find that it tends to be more travel oriented rather than cashback focused. Put another way, there's probably not as many people applying for the Platinum card if they know that airports are shut down and international travel is pretty much non-existent. On an unrelated note, if you are someone who wants to get 2 free stocks for trying out a platform and putting $100 in, I would look into the current Webull promotion. So if you sign up by the 11th of May, then you can get 2 free stocks. After this, it's going to drop down to 1 stock. It's SIPC insured up to $500,000, and like with a lot of other things, you can try it out and see if you like it. Link is going to be down below in the description box, and probably one of the easiest ways to support the channel, so I don't need to do a bunch of stimulus videos. The least affected was deep subprime as well as near prime. So I think there is going to be 2 different situations here. So with near prime, they tend to be pretty flexible. If travel doesn't make sense, you can go for cashback, and a lot of this demographic will focus on cards that end up just adding value in the long term. Factor in how many low-hanging fruit offers there are for cashback, where you typically get $150 or $200 back for $500 in spend as an intro bonus. That just makes a lot of sense. For deep subprime, I think it is going to be a bit different. They're treating this more as a cushion for their runway and to give them a bit more time. They typically don't pay off their cards, and that's why they have higher utilizations, missed payments and stuff, and why they have a lower credit score. But at the same time, by having these cards, they give themselves more potential to actually exist. So if I was choosing between having credit card debt and having food on the table for the kids, I'd probably have some credit card debt, but then actively work to pay that down afterwards. Credit card debt can snowball and it can get pretty bad, but at the same time, if it's between living and dying, I'll take a little bit of debt for short term. And obviously, it's ideal to save 3, 6, 12 months of runway in case something happens, in case we have a black swan event like we just did. But at the same time, if it already happened, there's nothing you can really do about it. You can only prepare for next time. Hindsight is 2020. If we look at this on a state-by-state basis, it also gets pretty interesting. So the most affected was the Northeast, California, as well as Michigan and Nevada. The chart we're looking at right now is specifically for auto loans. Nevada, I'm not too surprised by, given how much the economy is reliant on Vegas, and Vegas is pretty much shut down unless we see basketball there. Michigan, I'm pretty surprised by, but I don't have as much insight over there. My guess is that there's more people who work in industries that were laid off or who were going to slow down, and they knew that in advance, or maybe they were hit last time during the last recession, so they were like, hey, let's slow down with this type of stuff. New York is a pretty large state, but New York City makes up a pretty large share of it. And a lot of those people either don't need a car and it's more of a luxury, or you can work online. Least impacted was Mississippi, Kansas, Oregon, Utah, as well as Idaho. With that in mind, my guess is that people in those areas actually need cars in order to do their jobs, and it affects their ability to make income. If we look into the same thing for credit cards, the differences between states aren't as substantial. The most affected were Wisconsin, Iowa, Kentucky, as well as West Virginia. On an unrelated note, I'm actually a bit curious at whether we see different channels spike due to this, such as Dave Ramsey. Dave Ramsey Social Blade. Not really too much about normal, I would say, so that is a bit surprising to me. A bit of me does expect a spike after all of this happens, when people start settling down and they realize that they have this credit card debt and they're looking to get rid of it. For me, the biggest question still is going to be what the long-term impact of something like this is going to be for personal finance, as well as for stuff like credit card and obviously travel. Travel, I think, is going to be affected until at least the end of this year, and even then, a lot of people I know who do want to travel aren't really looking to do international travel. They're looking to just hang out with friends, drive and see family, and to just go outside and go hiking. Credit cards is pretty interesting because I don't think it's going to do well unless we start to see increased offers. So if they're looking to just recover their losses for 2 or 3 quarters, then it's going to be pretty boring and there's not really much to talk about. But if they do increase offers to account for the fact that people aren't traveling, then it gets pretty interesting. Personal finance as a whole, I think, is going to be a growing sector because people are going to see the impact of something like this and want to make sure that next time they're more prepared. Talking to people I know from Houston, it seems like every time there's a flood or something like that that happens, people end up stocking up on food afterwards and also just grabbing a bug out bag to make sure that if stuff hits the fan, they're prepared for it. With that said, my question for you guys is, what are your thoughts on this? What do you think is going to happen with credit inquiries for April and May? What do you think is going to happen with these other spaces moving forwards? Do you think certain ones are going to go down or go up? Let me in the community know in the comments down below. If you want 2 free stocks, we do have that Webull link that expires soon down below. And if you're someone who wants more deal type stuff, we do share that over on Instagram at AskSebby. So things that are a bit more short term that don't really make sense for videos, such as 60% off of an Uber Eats order when you link your Venmo account. So go follow us over there. If you like the video, give it a thumbs up. Really helps us out. If you know anyone else who'd benefit from what we just talked about, share this with them. It'll probably help them out. But otherwise, hope you guys liked it. See you guys next time. Very few people watch until the end, so I don't really expect a lot of people to catch that. So it's all good. Hey guys, it's Sebastian from AskSebby, and today